Okay, good afternoon, everyone. Welcome to today's CFA Israel Society webinar, organized in partnership with Colchester Global Investors. My name is Shachar Chen. I'm the CIO of Falcon Capital and Investment Partnership, and Society board member for the last 2 years. And I'm honored to be your moderator for this exciting session as Scott Gross, our chair, is in roadshow today in New York, so we all wish him luck for his fundraising closing. Today we have a few of Colchester team with us. We have a few of Colchester team with us. Some of you probably remember their event in Tel Aviv a few months ago. It was highly standard professional content, and I'm sure you all will earn extensive background on the foreign exchange environment, fixed income, and macro environment today. Colchester, a renowned UK-based asset manager with specialized focus on sovereign debt and currencies, they are managed close to 25 billion across emerging, developed, and frontier market, employ time-tested, real-year and real foreign exchange approach that has consistently delivered attractive alpha since their inception in 1999. Today, we're privileged to have 3 speakers, Mr. Leo Leiderman, David Botbol, and Mark Capstick. Now, let me introduce them. Professor Leiderman is the Jack and Lisa Ayel Professor of Comparative Economics in the Eitan Bergel School of Economics, Tel Aviv University, and the Chief Economics Advisor of Bank Hapoalim, the Israel's largest commercial bank. He's held senior positions including Managing Director and Head of Emerging Market Economics at Deutsche Bank, and Senior Director in Bank of Israel. With super prolific academic career, Professor Leiderman has published extensively in macroeconomic policy, monetary theory, and international finance. He has also advised central bank and ministries of finance around the world. Leo, by the way, I guess I was 10 when I listened to your lecture for the first time, and I never imagined I will present you in public. So that's nice.
There is always a first time.
Yeah. David Botbol is also with us, a Chief Investment Officer in Clarity Wealth Management, part of Sigma Clarity Group, that has 10 billion shekels in asset under management. With 35 years of experience in capital market, he has held key roles in major financial hubs, including Tel Aviv, London, Paris, and Tokyo. As co-founder of AlgoSave FinTech, Mr. Botbol brings wealth of knowledge in fixed income and equity derivatives. He holds MBA and M&A in accounting and finance from Nancy University in Lorraine, France. And Mark Capstick, Mr. Capstick from Colchester, is investment officer in Colchester Global Investors with extensive experience managing bond and currencies since 2000. Before joining Colchester, he was emerging market and currency investment manager in Fisher, French's Streets and Watts, and fund manager in Rexeter Capital Markets Management, where he specialized in Asian fixed income and currency investment. He earned his degree in finance services from Manchester Metropolitan University and holds a CFA UK Level 4 certificate in ESG investing. We are looking forward to engaging in insightful discussion today, and without further ado, let's begin with our first speaker, Professor Leiderman. Please go ahead.
Okay. Can you hear me well, Shachar, and everybody else?
Perfect.
Okay, thank you. So, hello everyone. I'm delighted to be with you today. Thanks to Analia and your colleagues at Colchester. Thanks, Shachar, for moderating this, and thanks to my colleagues, David and Mark, that will be joining me in this discussion. Okay, to sort of set the ground for the discussion, as a macroeconomist, I always start, from the top down, sort of. And when we look at the fundamentals for the behavior of financial markets this year, overall, I see very good news. There were some fears at the beginning of the year that we might enter some sort of a mild recession. When I say we, I mean the world economy. At the end of last year, beginning of this year, the Eurozone, especially Germany, were flirting with a severe slowdown in activity or recession, but things have been improving. The data had been quite good. We have to stress, though, that as of now, and for the years to come, it seems that the world will be growing, but growing at a much lower rate than we saw before COVID. Let's say the years 2017, 18, 19, clearly we saw a vigorous and very dynamic world economy. And for a variety of reasons, we are going to see the next 2-3 years, in our view, much slower growth. But at least this will provide an increase in profits, in activity, in business, in different areas and different sectors. So from that point of view, I see relatively good news. It is hard to see right now an upside, an immediate upside coming up from very good news on the real sector of the economy. So, as long as there is no major slowdown, things will continue to support financial market activities. I think that when we look at one of the key fundamentals for financial markets and for the real economy, interest rates, there has been quite a significant adjustment to a major change that we have seen in the last 2 years. When the war in Ukraine begins at the end of February 2022, the federal funds rate is 0.25%, 0.25%, namely 25 basis points. 2 years after that, or even in less than 2 years, the federal funds rate becomes 5.5%. And I must say that so far, the adjustment has been quite good. We have not seen a major wave of businesses defaulting or debt defaulting. And as a matter of fact, and I'm sure we will be discussing this, in some of the spaces that are considered as the more risky ones, like corporate bonds, and with specific characteristics, we are seeing a tightening of the spreads in those bonds rather than a widening, so that overall we are not seeing a major financial vulnerability being realized. And if someone told me, in advance, Leo, here we are, March 2022, the Fed funds rate is going to go up to 5.5% in less than 2 years, I never would have imagined such a sort of benign response of the real economy. Okay, and let me hope that this will continue, and this will be the idea here. On top of all this process, we are seeing a major revolution, a major change, and that revolution has to do with artificial intelligence, cyber, digitalization, and so on and so forth. And yes, this is here. This is giving all signs of impact on financial markets. If someone has any doubts, look at the behavior of NASDAQ year to date and other companies. And this is here to accompany us for the next decade at least. And we are looking for opportunities. One of the key opportunities are going to be in all what has to do with the spillovers the spillovers of the great benefits from this major technological revolution, industrial revolution, to different sectors of the economy, whether it is medical, education, financial, security, defense, you just name it, okay? Now, together with that, we are seeing something that is less welcome, and it is an increase in the degree of fracturing in the global economy, or I would call it deglobalization. Unfortunately, more and more economies, more and more policymakers are turning to populist policies. Sometimes they are on the right side, sometimes they are on the left side of the political map. And we see a rise in nationalism, we see a rise in national interests as opposed to global interests. And of course, this comes together with the world becoming a bipolar world economic order, where there is one sort of group, one bloc being led by the United States, and the other bloc being led by China, and together with Russia, Iran, and so on and so forth. And so it's a world in which there is rivalry between nations. It is a world in which the volumes of international trade, something that we as economists are always advocating, because we believe that international trade is a major engine for economic growth and for the welfare of people all over the world. There is a slowdown in the growth of international trade, and there has been an increase in the amount of trade disruptions. More and more countries are imposing tariffs, are giving subsidies to some of their exports, and so on and so forth. So there is, in that sense, this is probably one of the main explanations for the slowdown that we are seeing in the rate of growth of the global economy. Clearly, trade, as we said before, is an engine of growth, and if there are all these barriers, this can have an impact on different economies and different places. From the point of view of economic policy, we are facing, I think, some sort of a convergence of monetary policies. True, maybe the European Central Bank will lower interest rates quicker than the Federal Reserve. This is in any way what is embodied already in the markets, in the market pricing. We see the Fed lowering interest rates only once or twice this year. We will come back to that later on. And I think that, give and take different countries, inflation is coming down, even though I think that we are not far away from reaching some sort of a steady level of inflation of about 3% per year. In my opinion, it's going to be very difficult for the United States to reach exactly 2% per year. That is supposed to be the Fed goal. I very much hope, and again, we will come later on to this issue of some potential comments and criticisms or remarks on the Fed policy, that, if the Fed is very, very, I should say, anxious and very determined that 2% rather than 2.5% or 3% inflation, there may be a problem there. But this is something that we can discuss later on. Where there is something that is quite worrying coming up, and that is already with us, is in the area of fiscal policy. Because in the area of fiscal policy, it is as if the advanced economies are facing challenges that we always thought of are typical of emerging market economies. All of a sudden, we are all talking about issues of debt sustainability, debt solvency, and so on and so forth for the advanced economies, where, of course, there has been an increase in deficits and debt following the pandemic, and there was no choice by governments but to increase their deficits, health spending, vaccinations, and so forth, and so on. But there has also been an increase in the non-health and the issues that had to do with fighting the pandemic. And here we are in a world in which debt to GDP is at very, very high levels. Debt to GDP is at very high levels at a time that interest rates have risen very remarkably, A, because of the central bank policies, but B, because of the mere fact that the world of debt has become more risky, not only from the point of view of the accumulation of debt by sovereigns, but also accumulation of debt by households and by corporations. And clearly, this is one of the risk elements. So if you have a very high debt to GDP and you have a very high stream of interest payments on your debt every year, every budget year, and at the same time interest rates have gone up, then we are having some problems. And here we face something that, of course, I would like to learn more from my colleagues here, and so on and so forth. We have some sort of a puzzle, because when the Treasury market in the United States is pricing the 10-year U.S. Treasury at a yield to maturity of, let's say, 4.5%, 4.7%, and so on and so forth. The question is whether that indeed takes into account, whether that incorporates, whether that internalizes the fiscal risks for the years ahead. And it was not long ago, a few days ago, the head of the Congressional Budget Office, Mr. Swagel. We are not talking about an economist in a given corner of the world. We're talking about the head of the Congressional Budget Office, talking very clearly to Washington, D.C. about this graph of debt to GDP that keeps increasing, and talking about the fiscal risks for the United States. One of the sources for government spending, increasing government spending, has also been the increase in defense spending, because with the war in Ukraine, we see it, of course, in the Middle East, and with the risks and the possibilities of maybe a more a less harmonious world if and when Mr. Donald Trump is elected in the United States, and with the risk of China vis-a-vis Taiwan. Clearly, nations in NATO and other places have decided that they want first and foremost to have a modern army, modern security systems, to strengthen their defenses, something that they didn't do for decades, okay? And this is here again to stay. And so there will have to be some sort of fiscal accommodation in terms of the government budgets to take that into account. If we look at the world as a whole, I think the United States continues being the leading place in terms of equity investments. In terms of fixed income, of course, the whole fixed income space is the place where we have seen the major adjustment from low interest rates to high interest rates. And what we have seen is, for example, this year, capital losses, especially on the longer maturities. So something that should be the safer assets, government securities, so far this year have brought capital losses given the increase in interest rates in markets. And clearly, we have to look forward and see what is waiting for us. Clearly, from the point of view of those investors and those institutions that are looking to hold until maturity their investments, there has been an improvement, because in the years in which central banks held interest rates extremely low, the whole fixed income space was pretty much irrelevant. and some assets were yielding zero or negative yields to maturity. Right now, I mean, a US dollar deposit or a US Treasury bill and other securities are yielding very reasonable rates of return, nominal and real terms. But of course, if you're not planning to hold this to maturity, you are going to have to take care of some risks. And as discussed, one of the risks could be that we will see yield curves going up because of these fiscal sort of challenges. Even though, as I said before, we are not seeing the fiscal picture, in my view, affecting very dramatically so far the yield curves. And again, I leave it for my colleagues to discuss, maybe if they have the time, what do they think about this type of risks. From the point of view of emerging market economies, again, they look less risky in some sense than the advanced economies. And the emerging market universe this year is providing relatively reasonable returns. Of course, much lower than NASDAQ and much lower than those that are benefiting from the artificial intelligence revolution. But both emerging market equities and emerging market fixed income are having single-digit this year, single-digit rates of return. And when we discuss those assets, I think it is very important, once again, to keep in mind the issue of currency volatility. Because in my view, clearly, I think the local markets have become more risky or are risky. They have always been. But when we look at this year, for example, in view of the Fed policies, and in view of what's going on in the advanced economies, we see that a basket of emerging market currencies has lost about 4.5% of its value since the beginning of the year. Put differently, the dollar has become a stronger currency. Okay, now, so this is clearly something that has to be taken into account when we look at the local markets, local currency markets. From the point of view of the external debt or ADRs, I think that the picture looks better. And again, I think in looking for opportunities, those emerging markets that are going to be less affected by the deglobalization, that are going to be the first ones to adopt different elements of this technological revolution that the world is going through, those emerging markets are there to possibly to benefit from this whole process. And so I guess this would be my main points for the beginning. I see the main risks as the geopolitical risks, B, the fiscal risks. I think that for the interest rates, we're going to see either the interest rates and monetary policy staying where it is, or a bit lower interest rates, but I'm not putting too much hopes on that scenario, at least for the next year or two. And I guess that once again, we will have to follow this technological sort of developments that are going to be extremely important. So thanks for your patience, and I'm going to now listen very carefully to my colleagues. Thanks.
So before your colleagues, we have a few questions, and I wanted to ask the first one. I wanted to get you back here to Israel, to the local market and the local perspective. In terms of the war, you know, when I joined the reserve army in the October 7, I told to my soldiers, guys, we are think like Ukraine. The war of few years that take. How the war, in your perspective, it will affect or is affecting on the Israeli economy, which opportunities you see in terms of investment perspective.
Okay, thanks a lot, Hen. Clearly, we are in an unfolding situation. This war is a tragedy. It's a human tragedy for us. It's a human tragedy for the Palestinians. And one can only hope that this will end as soon as possible. Well, I can tell you that you had a lot of vision with your soldiers because I think that when Israeli policymakers, both on government, central bank, and others, were thinking of the impact of the war, they were thinking, we were all thinking that probably by February or March of this year, this episode is over. Because, you know, even the Yom Kippur War in October in 1973 was a brief war. But the more time passes, the more this becomes like a Ukraine war in some sense, that is a reality of day-to-day life. That is something that we cannot agree with, that we cannot meet in terms of our behavior and be satisfied with that. From the point of view of the Israeli economy, the situation is that we had a dismal last quarter of last year. So October, November, December less were a period of a sharp recession, very high mobilization of people to the reserve. Many companies where the CEO, the CTO, the COO were completely absent from work. Of course, a very clear negative impact on the construction sector, because our construction sector relies on about 100,000 foreign workers, most of them Palestinians, coming every day, every morning to work, going back home in the evening. And of course, this has created some paralysis in terms of the construction sector. But as also another sector that was immediately affected was the high-tech sector, especially those startups and those companies that were in the first stages of mobilizing new capital. All of a sudden, the very well-attended international conferences in Tel Aviv, Jerusalem, Haifa, where lots of people from technology worldwide are coming over and are sort of mingling and meeting new people doing technology here in Israel. All these meetings disappeared, and so on and so forth. But starting with the first quarter this year, it is as if there has been some normalization of some aspects of economic activity. There are less and less people being mobilized in the army. And from the point of view of construction, there has been some improvement in the situation. There is no doubt that we are going to have to rely on foreign workers that are not the Palestinians. Right now, it's going to take years, if not decades, to go back to the situation we were before the war, that we have this very talented and professional group of Palestinian workers, construction workers coming to Israel on a daily basis. This is not going to be with us for the next years. And so we have now people coming from India, Eastern Europe, and other places. And, you know, what we see is what we call here a routine economics. Or if you look at places in the center of Israel, Jerusalem, Tel Aviv, Haifa, the main cities, we see that day-to-day life has, for the most part, came to back to normal. Consumption has been increasing, and we see more and more business activities. I can tell you that in my capacity as Chief Economic Advisor of Bank Hapoalim, I get to meet every week directory boards, management boards of different companies in Israel. And I can tell you, everybody is continuing to work. And everybody is very hopeful that there will be soon a day after, okay? A day after, so that no one has gone into the bunker like thinking that this is not the time to continue with their activities. Of course, there is a tremendous uncertainty about all these things. The human pen is very, very strong, and we can see it everywhere. And the economic activity in the areas in the northern part of Israel and the southern part of Israel are quite paralyzed, and as the educational activities and other things. If this situation goes on, well, before I go on, the most clear sort of a boost to growth and to economic activity comes from government spending, okay? So, as it happened in World War I and World War II, in periods of war, the government increases its spending on defense, on security, on new contracts, and so on and so forth. So when you do the national income accounting, you see that consumption is pretty stable, investment has come down, real estate has come down, export, imports, nothing to tell home about it, but the most important factor has been the increase in government spending. This brings me to the most important economic challenge, and it is the fiscal challenge. Because as you know, Israel has been downgraded from A+ to AA-, from AA- to A+ by Standard & Poor's. Debt to GDP is increasing. However, we had very solid initial conditions. A country having the initial debt to GDP of about 60% and a budget deficit of about 2%, enters a very dramatic war, is of course expected to have a fiscal expansion. And so I think that from that point of view, things there has been no drama and no crisis in the financial markets in Israel at all. But if you look at the credit default swaps for Israel, and when you look at the differential between the returns in dollars for our dollar bonds of Israel compared to treasuries, it has been increased quite dramatically. So clearly sovereign risk has gone up. On the other hand, as I said before, Israel is a country that can afford some increase in debt to GDP, provided that it goes to the right places. The key question now is the 2025 budget and the whole process of economic policy making at the Treasury and the government. And what people and what the investors and what the rating agents are going to be looking is the extent to which the government sort of attempts to try to keep a fiscal discipline. So if the budget deficit this year is going to be about 8 or 9%, maybe next year about 4% of GDP, something like that. And they are going to look, we are all looking at the composition of the budget. To what extent the government is going to put more emphasis on those items in the budget that contribute directly to productivity, to infrastructure, to growth. And unfortunately, in the last 2 years, we have seen a lot of government money and public money going to what we can call, as macroeconomists, non-productive items in the budget that, you know, it happens in any country. There is a coalition government. But if we are in a stressful situation, as much as the one we are nowadays, one can expect to be more sort of growth-oriented than in the past 2 years, and this is my hope.
Thank you. That's a wide perspective. Thank you very much. So
thank you.
From the local policy, I want to take you to the U.S. policy. As a former central banker, you have the perspective of central banker. Do you have any specific comments or criticism on the Fed policy? That I mean, if you see, for example, the PPI of last week and the CPI of last week, you see the declining in prices, and we saw the dot chart with the wide dispersion. Don't you have they have a window to policy mistake in terms of that?
Well, I'll be very brief because I'd like to have this meeting move on to the next colleagues and friends. From my perspective as a former central banker, I always thought that central banks ought to be forward-looking, and that the data that you have seen represents the past. It does not represent the future. Whether it is labor market data, inflation data, and so on and so forth. And when you are setting interest rates, given the lags of monetary policy, you're setting interest rates based on your anticipation, on your predictions, on your forecasting of the future. In my view, the Fed, and clearly, I like the idea that policy should be state dependent, that policy should be data dependent, because nobody knows how the next year and the next 2 years are going to look like. But what I'm going to say is not something that I can prove with a theorem or an economic model, but it is my feeling that the Fed over time has become more and more backward looking rather than being forward looking. Okay? And when you hear Mr. Powell speeches, you know, talking, for example, about the labor market in full employment and so on and so forth, look, all the evidence we have from labor economics suggests that typically the labor market is a lagging indicator. It's not a leading indicator. So if a country enters a recession, the labor market is going to be the last one to tell you that unemployment has gone up and employment went down, okay? And there are other variables that are going to be the first ones to discuss that. The same about inflation, you know, okay, we can see inflation developing and so on and so forth. But we see that the Fed and other central banks have a lot of credibility measured by the expectations of inflation in the future. And therefore, to me, this is an important anchor of monetary policy, not less important than the last inflation numbers. And so, but on the other hand, look what has happened. We are all quite anxious waiting for Friday this week to hear the numbers about the core PCE inflation in the United States, whether it's going to be 0.1% as the consensus, or more or less. And people are saying, yes, but notice the next month, probably for seasonality reasons, it's going to be even higher. You know, so I think the policy has been too much dependent on the past, on backward-looking elements, and I believe that there is a lot to be improved in the dialogue between the Fed and the financial markets, and I truly don't like this ultra dependence of financial markets on a specific decision by the Fed, that we know that it's not going to be a very dramatic one, because whether the interest rate, the Fed funds rate remains 5.5%, or it goes to 5.25%, or even 5%, it's not a major drama. It's not a dramatic event. We are not going back to the interest rates of 1, 2, or 3% that we saw sometimes ago. So I guess this is a very important point. Of course, the Fed has to be careful, and it is careful. And even if the inflation numbers are good, it has to be very careful. I saw an interview by my good friend Larry Summers a day or 2 days ago, And Larry is saying that the inflation is going to come back. Larry is quite worried about inflation in the U.S. economy. And so, yes, there are some people from that point of view, and maybe this brings some thoughts of maybe raising interest rates at some point, even though I don't see that coming up in the next few months. So, just to summarize, this idea of backward versus forward-looking is something that I think that if and when history is written, there will be much more criticism of this type of phenomena. Thank you.
Thank you very much, Leo, for this brilliant word. And we are moving on to David from Sigma Clarity. And David, please go ahead.
How are you? Leo, thank you very much. We have been colleagues for about 13 years when I was working at the Bank Hapoalim. I always enjoy your point of view for many reasons. One of the reasons is because they are, I would say, they're special. And it's very enriching to listen to what you say.
Thank you.
They bring a lot of value, and I should spend a lot more time with you. Unfortunately, we're no longer in the same building, so it's more difficult. Shachar, would you like to start with a question, or shall I just,
when you develop yours capital market expectations in terms of risks and maturities, the first question I want to ask is, where are you find yourself, you personally, or you as institutional money manager? What do you prefer those days in terms of how you see the investment grade segment or in the high yield segment?
Interesting. I would say I like both, but I like one on a long position and the other one as a short position. So I like being long investment grade. I think these days investment grade corporate, I'm talking about the US dollar market, do bring some attractive risk-adjusted return, at least if you look at the expected credit loss of an investment grade borrower, especially corporate borrower, and you look at past default, realized default, and past loss given default, you would see that on a senior unsecured corporate bond, let's put for one moment financials and asset finance, meaning real estate finance on the side, but cash flow finance. So typically, I would say 7 or 8 of the big GICS sectors of Bloomberg, these corporate offer roughly 80 basis points.
Cool.
Something happened to my camera for some reason. So I was saying that I would be long investment grade, especially in the US dollar market. By the way, I'm mostly a US dollar investor for one of the reasons that Leo just stated. I think that US dollar supremacy is still here to stay for some time. And I think that the euro is a challenger to the US dollar currency, but we're not there yet. I think the US has still at least another 5 to 10 years as a global reserve currency. So for now, at least in our portfolio, we prefer US global portfolio. We prefer US dollar investment. So that's for the investment grade. When it comes to high yield, I'm actually very happy shorting high yield. And I usually do this through credit hedge fund. I love the asymmetry of the strategy of shorting high yield. I think one of the best strategies in high yield is to short high yield bond priced at 97 cents on the dollar, just around the issue date. Usually this bond have a call at par. So you know that when you go short, the least you can lose or the maximum you can lose is actually 3%-ish, because if we go beyond that, then there will be a call from the issuer, plus the carry, because you're shorting, so you have to pay the interest, let's say 7%. So the expected or possible loss is maybe 10. But if indeed, and this is very much a recovery play, that senior unsecured piece of high yield bond, which stands usually very much junior to first lien, second lien bank loan, if that paper defaults, the recovery will be around 20 to 30 basis points. Yeah, historical junior subordinate recovery is around 20%. So if you think about it, that hedge fund has shorted a 97 cent on the dollar, losing 7 on the carry. So they're like, the break-even is 90. And if they're able to buy the paper back at 30 or 20, that's quite an interesting trade. So long investment grade and short high yield.
I see. And when you're choosing your allocation in your investment process, you mentioned you do it to other funds or directly to the market. I wanted to ask how you make your choices, how you make your research in terms of that.
Very good question. I would say here it's a bit of both. I like direct approach, meaning buying bonds directly in the market. I will tell you roughly how we do it. It's quite a lengthy and a deep fundamental analysis process. And I also like private credit. And in private credit, there are certain pockets which today I prefer to other pockets. And I will also tell you why. So let's just start with direct bond buying for corporate. Again, I will just concentrate on dollar bonds. Mm-hmm. The process we have here is, first and foremost, for every client, we make a Bloomberg search and we filter the entire Bloomberg bond universe, which counts today something like 350,000 bonds. That's enormous. And then we filter them using a clients or investor constraint, which could be, for instance, I don't want any real estate, I don't want any emerging market, I want high coupon, I want liquidity, which I translate into a BVAL score of at least 8. I want a minimum outstanding amount of at least 400 million, and so on and so forth. And we end up with a family of bonds, which already are available for clients, at least from a constraint point of view. At this point in time, we compare those bonds. We use a function called COMB. So we compare those bonds on what I will call an efficient frontier, where we have risk being turn of leverage, so net debt over EBITDA, and profit or return being simply the credit spread of each bond. And we look for the efficient frontier on that big family of bonds by maturity. And then we pick up what we think is the best risk-adjusted return bond on that efficient frontier. And then those bonds we put through a very deep stress testing experience or exercise, where we take the financials of these borrowers, which we project forward, apropos Leo's advice to central bank to look forward. This is exactly what we do. We push financial of issuers 10 years forward using Monte Carlo simulation, multi-step Monte Carlo simulation, and we look for events of default, and at which point we compute loss given default. So for each borrower in our universe, we have a term structure of default probability and term structure of loss given default. And then we stress test that, and we end up with the bond portfolio that we want to have for our clients, for a client's portfolio. We usually have a minimum of 20 bonds. At this point in time, we have what we call a relatively diversified portfolio. When it comes to private credit, I like a barbell strategy. I like to go long investment grade in the world of private credit. I'm not yet, I'm waiting for a better entry point in direct lending funds. These days, direct lending land at around SOFR plus 450. I loved them last year when they were at 500 or 650. I think that the enormous amount of dry powder, as well as the new entry of CLO and the new entry of the re-entry of banks into leveraged loan market has tightened very much the existing credit spread in the direct lending space. So I'm waiting, but I go for investment grade through SRTs, significant risk transfer. A few players have entered that area, and especially in Europe. And I also like what I call opportunistic credit fund, NPL, for instance, or distress. Mm-hmm. So, or mezzanine finance. So very much very good quality or as close as possible to equity. That's the way I would form portfolios.
I see. And you mentioned the private credit, and I want to talk with you on the less tradable instruments as CLOs or purely private credit. What are your insights in that field in terms of defaults, data, or severities in that field in this current term?
It's a very good question, because the world, as Leo just told us, the world has completely changed. Just to give you some flavor, the interest coverage ratio at the end of 2021 was probably in that world between 3 times and 4 times. You remember SOFR was about 0.5. Mm-hmm. So the only thing that borrowers in the private credit space were paying, especially in direct lending, they were basically paying 6 to 7%, which was exactly their credit spread, plus half, plus of course structuring fee. These days, especially in the small and medium cap direct lending space, this in interest rate coverage ratio has dropped from 3 plus to 2 minus. So if you think about it, after the EBITDA, what you have roughly is just interest payment. Some of those corporates, especially if you make just 100 million EBITDA, per se, if you have to pay, let's say 60 million, if you look at a LTV of 40% and a debt to an turnover leverage of 6, you have to pay something like 60 million worth of interest. EBITDA 100, 60 million worth of interest. That doesn't leave you with a lot of cushion for error, especially if your top line, which is sales, goes down. So I would expect a severe and more default in the very near future. And by the way, I just looked at the JP Morgan latest research, and you can see that distressed exchange year to date has reached close to 22 billion. That's the highest since 2022, and it's the third highest on record since the global financial crisis. And if you just concentrate on leveraged loan distressed exchange, it's actually the highest ever since 2008. So we are starting to see default, especially in leveraged loan market. So let's not sleep on we are looking at a risky market.
Yeah, we also have a lag effect, as Leo mentioned before. It's like in the global financial crisis, you see most of the defaults was in 2010 and not in 2008. So you have a bit lag effect. In your perspective, what explains the low spread? You see, I analyze the option adjusted spread in my platform, and you see quite low spreads. Given the high geopolitical risk and the delinquencies or the defaults you mentioned, and the challenges in the business environment, how you explain what you see in the markets and what you see in the reality?
Okay. I have to say it's also a puzzle to me. So, and one of the reasons you just gave, I'm sure there is a lagged effect. Mm-hmm. So, what you see is not what you get. today we have relatively low credit spread. Just to give you some idea, and everybody knows this, but back in 2022, back at the end of 2021, the spreads on the high yield were trading around 320. It exploded to 650 at the end of 2022. We're back at 370. So yes, we seem to be in a very interesting market and low risk market. I think one of the reasons is that volatility is suppressed. When you look at the VIX, which is about 12.75, volatility is definitely suppressed. And when you suppress the volatility, you also suppress volatility on credit spread. They go together. When you think about it, when you're long a bond, you're basically shorting a put option on the EV. This is what Professor Merton taught us and received a Nobel Prize for that. So there's a reason why low volatility go together with low credit spread. That's one reason. I think the second reason is that a capital market has opened even to B3, which is interesting because of CLO and leveraged loan market who have reopened. So that's something we should also take into account. But I'll be very careful and I'm expecting a spread to actually widen. We already saw it. Yes, the HYG US famous ETF trade at 360. We're coming from 320. So it's starting to happen.
Mm-hmm. Interesting. Thank you. So, Mark, you said so quietly, but now I go into the rain of questions for you. Your field is mostly the sovereign market and the FX market. In your point of view, what opportunities you see in the sovereign space in the emerging field versus the domestic dollar US field of sovereign and currencies?
Well, thank you very much, Shahar, and thank you for the introduction. And first of all, of course, thank you very much to Mr. Leiderman for his speak. It was very, very interesting. Actually, as a sovereign bond manager, these macro themes are very much in tune of what we're seeing around the world. And David, thank you again for your comments as well. And maybe there's a few things that we can discuss and how we see the world there as well. So maybe just before I jump into the question, as a sovereign bond manager, of course, we are seeing an increase in risks around the world and on the macro side. And yes, I very much share the view, of course, on the fiscal sides. We are, as a sovereign bond manager, looking at those government bond balance sheets and, of course, fiscal and the lack of fiscal prudence in some economies is somewhat concerning. So maybe we can pull a bit of those comments apart later. And of course, we can jump in deeper. Of course, interest to revenue statistics in some countries are degrading. Simply put it, of course, interest rates are a lot higher. And of course, the world is completely different after the pandemic. So maybe just to look into the two major asset classes that we look at. Of course, we've got a developed bond program and the emerging market program. Perhaps the first thing I would like to address is the emerging markets, simply because the prudent fiscal policies that they've had in place has meant that there hasn't really been any substantial signs of any sort of emerging market crises that you would expect with a big problems that you would expect in a global pandemic. Of course, sure, there are in frontier markets, the likes of Sri Lanka and Pakistan, but local currency, high quality emerging markets have really done well and kept their fiscal prudence in place. So roughly speaking, you're seeing debt levels increase at around about half the levels that you see in the developed world. And with that, of course, we do see opportunities and opportunities across the asset classes. So right out of the question in terms of where do we see opportunities, clearly in emerging markets, there are opportunities. The real yields, at least this is the way that we look at value, that is nominal bond yields adjusted for inflation, have increased significantly since the pandemic. And we feel that we can build portfolios of around about 5% real yield. That's after considering inflation. And that gives us a strong base for investors. The second thing I'd like to address is, of course, the US dollar has become ever more, let's just call it, overvalued. So, of course, there are many currencies in the world, in developed space as well as in emerging space, where we can lean into those currencies that are considerably cheap, and also bring some added value to our portfolio. So maybe just looking at, again, the emerging markets, typically we're seeing around about 15 to 20% of undervaluation in real terms, that's purchasing power parity terms, which we can add to that substantial real yield. And that ends us with a portfolio that we're seeing between 9 and 10% per year of annualized value. And that is almost double what we see in terms of the medium term, so the long-term average valuation for emerging markets. So quite clearly, this has been interesting to us. We're excited by the valuation in the asset class. But of course, we're already seeing some considerable flow into that asset class. So that's probably the number one message, is emerging markets, local currency emerging markets continue to offer good value, and around double the value that we see historically. In developed markets, of course, there is a range of valuations, and we see much better valuations. That 4.5% that we saw Mr. Leiderman mention in terms of the nominal yield in the US, of course, we would adjust that for our forward look on inflation. And we also see inflation a little bit higher than long-term average. So our 2-year inflation forecast, for example, on the US is around 2.3%. So we are seeing some considerable improvement in valuations in US Treasuries, but there are opportunities elsewhere that we can build portfolios with much better value. So, of course, real yields in somewhere like New Zealand and Australia may be approximately the same as where we see in the US. When we consider financial balance sheet, of course, the US is debt GDP pushing 100%, fiscal deficits of around 6.5%, and very, very likely to stay. Of course, we would prefer to hold overweight positions in some of these AAA names like New Zealand and Australia in the government bonds in our developed program. In developed space, though, maybe just in brief, we do see the US dollar as being significantly overvalued, as we mentioned, and some currencies in developed space are considerably cheaper in real terms. So if we look at the likes of the Japanese yen, of course, 50% undervaluation compared to the US is significant, but we're also seeing countries with very, very strong balance sheets, the likes of Sweden, Norway, their currencies also being considerably cheap. And of course, we can build portfolios with very attractive valuations. And again, real yields, the increase in real yields on the developed market program, of course, has increased. And we can build portfolios with around about a 3% average real yield on a developed market program. But with that currency weakness or the undervaluation that we see in developed space, we can also add a considerable amount of valuation. So again, anywhere between 4 and 5% is the average valuation that we can add to the real yield. And we're seeing, again, double the valuation in developed market space. So bringing us around an average real valuation on an annualized basis of 8% in developed space. So double the long-term average, again, since we've been managing those assets since the year 2000.
I see. And one more question, please. When you mentioned the emerging space, you look at it as aggregate, or you have specific countries, specific market that you see a particular process, economic process, qualitative or quantitative? What is your insight about this segment?
Excellent. So when we look at any government bond market, we start with the real yield valuation, and that essentially means taking a forward look on inflation and then using that as a discount rate to the nominal bond yield. And actually at the moment, although of course I've mentioned emerging markets, the asset class is showing substantial valuation. There is a range of valuations within the bond market space, which is actually fairly extreme. So maybe if you're looking at markets like, for example, South Africa, Brazil, Indonesia, and Mexico, these are offering substantially higher real yields than where we've seen in terms of long-term average. Many of the countries that we look at in the likes of emerging Europe have considerably lower average real yields, and so that means for an active bond manager we can increase our risk taking. So obviously having larger overweights and underweights out of Europe, but we're also seeing some substantial undervaluation, lower real yields in the likes of China. So we're avoiding Chinese government bonds. Their real yields are considerably lower at around about the 1.5%, compared to real yields that we're seeing obviously in Brazil, South Africa, well and truly above 6%. So very, very attractive for us as an active bond manager.
I see. Thank you. We have one opportunity for someone for the audience to ask questions. So if there's someone want to ask something, questions for those brilliant giants, so that's your time. Please just unmute and present yourself in short. Five seconds. Okay, so I think you answered all the imagine of the people questions. So okay, everyone, we are come to the end, to the close of today's webinar. I would like to extend the heartfelt thank to our speakers, Professor Leiderman, Mr. Mark Capstick, and David Botbol. I learned a lot of that, and I'm waiting for those Inside You event in the next month. I will tell to our society that we are work on the more event like this, also in person. Scott and the other board members work a lot on that kind of professional networking and professional content. So I'm looking forward to those events. And again, I wanted to thank Analia from Colchester for the organizing this grand event. And again, for you, our great speakers, Leo, Mark, and David, thank you very much.
Thank you, Shahar.
See you. Bye-bye, everyone.
Bye-bye.
Thank you.